REITs are today avoided by most investors, and this explains why they are trading at decade-low valuations. But despite this low market sentiment, most REITs are actually performing quite well and continue to grow their cash flows and dividend payments. It seems that most investors have been misguided to think that REITs own for the most part office buildings, hotels, malls and other struggling property sectors, and that they are over-leveraged and heavily exposed to the recent surge in interest rates. But that's not true at all. In reality, most REITs own high-growth property types like e-commerce warehouses or data centers, cell towers, manufactured housing communities, farmland, and so on. And the leverage is very low in the REIT sector. In fact, it's the lowest it has ever been, with an average LTV of just around 35%. This explains why REIT cash flows and dividend payments have kept growing in 2022, 2023, 2024, and will likely again grow in 2025 despite their declining share prices. This has resulted in some exceptional investment opportunities to acquire high-yielding, rapidly growing REITs at discounted valuations. Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to discuss 3 high-yielding REITs with dividend yields of up to 10% that are also expected to keep growing their dividends at a rapid pace. The first REIT that I'm going to discuss is called Sila Realty Trust. Its ticker symbol is SILA. This is a healthcare REIT that came public just about a year ago. It's today offered at a near 7% dividend yield, and that's despite having a low payout ratio of just around 70%. Typically, such high yielders are not offering much growth, but we think that Sila is an exception. We think that it's well positioned to grow at a rapid pace in the coming years because of 3 key reasons. The first reason is that most of its properties are under triple net leases, meaning that its tenants are responsible for all property expenses, including even the maintenance, and its leases include 2.2% average annual rent escalations, and this should fall straight to the bottom line, again given that its tenants are responsible for all property expenses. Secondly, the company retains about 30% of its cash flow, which is significant to acquire more properties, and it's targeting mostly these single-tenant net lease medical office buildings, inpatient rehab centers, and surgical facilities which come with high cap rates of about 8%. On a leverage-neutral basis, we think that reinvesting this 30% of cash flow should result in about 2% of annual growth. And then the third reason why we think that this REIT is well positioned to grow at a rapid pace is because today it's under leveraged. Its average LTV is just around 25%. Its debt to EBITDA is about 3.5 times, which is well below its target of about 5 times debt to EBITDA. And this means that in the coming years, it's going to be in a good position to keep buying more properties to expand its portfolio using additional debt. It has additional capacity to buy new properties, and this new acquisition should be highly accretive to its FFO per share, given that its average cap rate is about 8%, but the new interest expense will be around 5.5% on its new debt. So there is a 200 to 300 basis point spread on its new acquisitions. Assuming that they take 2 to 3 years to bring their leverage back to their target, we think that this would add another 2 to 3% of annual growth to the company. So now putting all of this together, we had 2% rent escalations, 2% growth from reinvestment of the retained cash flow, and then we have another 2 to 3% of growth from spread investing as they add more leverage to their balance sheet. So all in all, we think that they should be able to grow at 6 to 7% per year. Even assuming that they run into some occasional tenant issues, I think that they should still be able to grow at about 5% per year, which is very attractive, again, given that this REIT is offering a 7% dividend yield. A simple way of calculating expected returns in the REIT sector is to simply add the dividend yield and the expected growth in its FFO per share. And in this case, we have a 7% dividend yield, about 5 to 6% of annual growth. Together, this should easily result in double-digit total returns, and even 12 to 15% annual total returns, I think here are quite realistic. And that's without any expansion in its FFO multiple. But we think that the company is also likely to see its valuation expand in the coming years because, quite frankly, we think it's undervalued. Right now, it trades at just around 10 times its AFFO. Typically, REITs of this quality, with this little leverage and such a strong investment strategy, trade at closer to 15 times. So this means that it has about 50% upside potential. Even if you're more conservative and you think that it won't reprice quite that high because it's a small cap REIT, let's say it reprices at 13 times FFO, that would mean 30% upside. You add that to the growth and the yield, and you have very attractive expected returns from this specific REIT. Finally, for those of you who worry about the recent surge in interest rates, I would note that this REIT has no debt maturities until 2028, and therefore it's not impacted by it. We just recently doubled down on Sila and bought a lot more shares for our portfolio at High Yield Landlord, and as a result it now represents about 7% of our core portfolio. By the way, if you want to access the full portfolio, we are today offering a 2-week free trial. It will be the first link in the description of this video. Okay, so now we're gonna discuss the second REIT, which is First Industrial. Its ticker symbol is FR. This REIT is offering a much lower dividend yield, however it's growing at an even faster pace. First Industrial is one of the leading industrial REITs, so just like Prologis, but it's smaller in size, and it focuses mostly on supply-constrained coastal markets. Its dividend yield right now is just 3.5%, however you should know that it hiked its dividend in 2024 by 15.6%. And 2024 wasn't an outlier. This REIT has been growing at such a rapid pace for many years in a row now. And we think that this rapid growth will continue in 2025 because of two key reasons. Firstly, their current lease rates are deeply below market, and it allows them to significantly bump up their rents as their leases gradually expire. In 2023, they managed to bump up the rents of expiring leases by 58%. Last year it was closer to 50%, which is very significant. This year, these releasing spreads are expected to come down a bit because some of its markets are dealing with oversupply, but so far they're still getting a 33% average annual rent bump on their expiring leases, which again is very significant. And then the second reason why this REIT is well positioned to keep growing at a rapid pace is because it owns a significant land bank. This is land that they own, but it's not generating any cash flow yet, but it's there and they can now gradually develop it, build new properties, and so far they've been able to earn a 7% average yield on their new development projects. And just like Sila, First Industrial has very low debt with a 24% LTV, and this positions them to keep growing in the coming years as they take on more debt, perhaps raise some equity, to keep reinvesting in these high-yielding development projects, resulting in a significant spread over the cost of capital. Our expectation is that the company's growth in FFO per share will slow down to about 8% per year over the coming years, but even 8%, you add to that the 3.5% dividend yield and you're getting to roughly 12% average annual total returns, which is very attractive in my opinion, coming from a REIT of such a high quality. On top of that, we think that the equity of the company is significantly discounted and should enjoy substantial upside in the recovery of this REIT bear market once rent growth reaccelerates once again as the supply gets absorbed and interest rates return to lower levels. So far, the stock of First Industrial has dropped by about 30% in this REIT bear market, but you should also consider that its cash flow has risen by 20% over the same time period, meaning that today its FFO multiple is 2 times lower than at its most recent peak. And so just returning halfway to its previous peak would result in 50% upside from here. Hey, before I go into the last company, can you please do me a huge favor and click the like button if you enjoy this type of content? That will help me a lot to keep on growing. Thanks so much in advance. The third company is the highest yielding of this list, and it's NewLake Capital Partners, ticker symbol NLCP. NewLake is one of just a few REITs that specialize in cannabis cultivation facilities. The other one is Innovative Industrial Properties. It's today priced at a 10% dividend yield, and that's despite having a reasonable 80% payout ratio. And unique to NewLake is that today it has close to no debt. It's one of a few REITs that's not operating with much or any leverage on its balance sheet once you account for the cash that they have. And historically, it has managed to hike its dividend in nearly every single quarter since going public. Its target payout ratio range is between 80 and 90%, and right now they're at the low end of this range, which seems to suggest that they're likely to hike their dividend once again in the coming quarters. The REIT is growing steadily because it has no leverage, it has long triple net leases with 14 years on average left on them, 2.6% annual rent escalations, and finally it's also retaining about 20% of its cash flow to keep buying more properties and also buy back shares while they're discounted. And while NewLake is not retaining quite as much cash flow as Sila as an example, it's important to remember here is that NewLake is getting much higher cap rates. The cap rates of cannabis cultivation facilities are in the 12 to 15% range, and therefore it's really moving the needle for them. Retaining 20% and buying a property at a 14% cap rate is the equivalent of retaining 40% of your cash flow to buy properties at 7% cap rate, if that makes sense. And so this really moves the needle given that the cap rates are so high in this specific property sector. Adding together the growth from the rent escalations, the reinvestment of retained cash flow, and perhaps the REIT in the future taking on some leverage on its balance sheet to buy more properties just like its peer Innovative Industrial Properties has trust, I think they should be able to grow at a high single-digit growth rate, even despite offering such a high yield. However, we're also aware that this is a riskier property sector and therefore it's likely to run into occasional tenant difficulties, so the growth won't be as consistent as in the case of a REIT like Realty Income. It's going to be much bumpier with occasional setbacks along the way. Even then, it still should be able to grow at a mid-single digit growth rate, which is very significant for such a high-yielding REIT. And so now we can come back to our earlier expected return calculation. We have a 10% dividend yield, we have 5% annual growth, that gets you to 15% average annual total returns. That may seem like very high, but remember, this is a high risk property sector, so it's actually quite reasonable, I think, for in relation to the risk that you're taking. And perhaps in the future, we also have the catalyst of the legal environment changing and becoming more favorable for cannabis companies. This would make the tenants of NewLake more resilient, it would lower its cost of capital, and the market would then likely reward NewLake also with a higher equity multiple, especially if it's able to list on a bigger stock exchange like the Nasdaq, and this could lead to significant upside. Right now it's trading at just around 8 times FFO, even with pricing at just 12 times, which is still way below average for the REIT sector, would unlock about 50% upside from here. Combined together, these three REITs offering a 6.5% dividend yield, and they should be able to keep growing at a rapid pace, far surpassing the rate of inflation. They are great examples of the type of REITs that we like to target at high yield landlord because they are undervalued, they offer a high yield, and they're able to keep on growing their cash flow and their dividend even despite today's challenging environment. Once more, if you want to access our full portfolio and all our transactions in real time, you can join High Yield Landlord for 2-week free trial. You won't be charged anything for the first 14 days. You can cancel anytime, no questions asked. It's the first link in the description of this video. Thank you very much for all of you who watched till the end. Please click the like button, that helps me a lot. Thank you very much and see you at my next one. Bye bye.